Is lending in the United States a winner-take-all market? I think it absolutely is. Really, the next 20 years of opportunity we see is in this convergence of what we call kind of private equity meets venture capital. If I had a few $100 million, I would go buy a bank, probably like a community bank. And I'd buy that bank and I'd say, wow, literally this bank is turning away 30 to 50% of its existing customers who want debt.
More in the case of small businesses.
More in the case of small businesses, and a lot of what these community banks are seeing on a day-to-day basis than maybe a national bank. And so if I can now buy this bank, and I literally have at least 30 to 50% of my customers that I'm turning away because I can't underwrite them. But there are so many fintech lenders that would love to underwrite these people. They just can't get access to them. The CAC is so expensive. How could you now put the fintech lender community, which can be much more innovative in its underwriting approach, which isn't as regulated, and connect the small businesses, the personal borrowers, and put these two things together? And then now I take that linear community bank multiples, again, which are suppressed, and now can spin out a marketplace on top of that. You show the two things here. Is lending in the United States a winner-take-all market? I think it absolutely is. And if you can now start to show, hey, look, I'm monetizing the 30 to 50% of borrowers that I'm turning away, and I'm now earning fees on that. The capital's coming from a third-party fintech lender. I still own the banking relationship with the borrower. They now actually have to use my bank account to service the loan that was provided by a third-party fintech lender. I mean, think about what that does to not just the multiples you get on the marketplace, but to the core business. And this is where we really see the next 20 years is not VC. We've spoken about how for the past 4 years in a row, we've seen year-over-year decline in the number of first financings for startups. And really the next 20 years of opportunity we see is in this convergence of what we call kind of private equity meets venture capital. Private equity, you take these linear, what we would call undervalued assets. And it's kind of value investing meets growth investing, by the way. So a value investor says, hey, there's a lot of assets in this linear business, and it's actually valued at suppressed multiples. If you can deliver on saying, I'm going to take these assets the linear business has and capture those and deliver on those in the platform model. And when I put the linear and the platform model together, not only do I get a huge bump in multiples on the linear business, but then I also have a growing, very fast growing platform business, which has insane multiples and insane growth prospects. You put the two of those things together, it's huge value creation. And that is really the theme of, if we've seen platforms for 20, 25 years now. We've seen VC really take its shot for the past 20, 25 years. But the heyday going forward is really, how do these ripple effects of platform models continue to move into more traditional, maybe more sleepy industries, maybe more regulated industries that a VC isn't going to get into? Or industries like B2B that a VC isn't going to get into because you have Amazon, Walmart, Alibaba, and eBay already there. The VCs just aren't going to fund these businesses. But this is where private equity could really come in and start to change the traditional PE model for the better, right? And this is really exciting value creation stuff.